Good afternoon. I'm Jeff Mechanic. I am a senior project advisor at the Financial Accounting Standards Board, or FASB, and I wanted to thank all of you for joining us this afternoon for an update on the FASB's activities. Before I begin, let me state that any views that I or any of my fellow speakers share during this webinar are our own because official positions of the FASB are reached only after extensive due process and deliberation. Next slide. Speaking of fellow speakers, these six individuals will be joining me today in the webinar, and they are Christine Bodizin, our FASB board member, Deputy Technical Director Rosemary Sangiulio, Postdoctoral Fellow John Schlumberger, and our two awesome project managers involved with our academic initiative, and those are Senior Project Manager Jill Switter and Supervising Project Manager Lauren Motley. Last but not least, behind the scenes, we also have Jack Sherman, one of our terrific postgraduate technical assistants, and John will be talking about our PTA program later in this webinar. Let me start with some housekeeping items. First, slides can be downloaded by clicking on the Event Resources tab on the left side of your screen. If you have a question, please type into the Ask a Question box on the left side of your screen and click Send. And again, we encourage you to ask us questions. And of course, remember to turn off your pop-up blocker. Next slide. A recording of this webcast will be available online for 12 months on the Educational Webcasts and Webinars page of our FASB website. CPE credit will not be available, however, to those who watch the archived program, only this live program. If you have any questions about this webcast or any of our other educational webcasts, please contact the FASB at CPE Director, all one word, at fasb.org. CPE credit is available for viewing this live program. Today's program will be worth approximately 2 CPE hour credits. CPE credit is not available for group viewing. You have to log in individually in order to be able to receive credit. Now, to receive CPE credit, you must stay on for the required number of minutes, in this case, about 100 minutes, and you must respond to the required number of polling questions. Now, we will be asking you a total of, 8 plus 1 bonus question, just in case you miss answering these. Total of 9 questions. You must answer at least 6 questions. There's no right or wrong answers, as you'll see, in order to receive your full 2 hours of CPE credit. And please allow 2 weeks to receive your certificate via email once this webinar concludes. Let's move on to the next slide. So a couple of polling questions, a couple of demographic polling questions straight off, just for us to get to know you a little bit. The first of those questions is the following. Which of the following describes your current place of employment? And here you're going to choose only one. A U.S. private university or college. B, a U.S. public university or college. C, a U.S. community college. D, an international educational institution. Or E, other. And while you're answering that, Christine, I didn't know if you wanted to just say a couple of quick words of hello.
I would love to. Thank you all for joining us today. I know that many of you who have just started teaching are incredibly busy. So I very much hope that you get a lot of value out of being with us today. I think you will. We've got a lot of material to share with you. And the slides are also available. We have them in PowerPoint form, which will allow you to use them in class if that is helpful to you. So again, thanks for being with us today.
Terrific. Thanks, Christine. Let's push out the responses here and see what's our audience mix look like. So we have, as you'll see, almost half of you are with U.S. public universities. 16% with private universities, 6% community colleges, 4% international educational institutions, and about a quarter of you are with some other organization. Now let's move on to our second polling question, a little bit more about you. Which of the following best describes your primary role or job function? And as with the first question, just choose one here. Which one best describes you? Are you a tenured professor or teacher? Are you a tenure track professor or teacher? Are you an adjunct or clinical professor or teacher? Are you a department head? Are you a PhD student, or does something else best describe your role? And while you're answering that, one of the things you'll hear about during this webinar, and some of you already are aware of this, are the FASB action alerts. Those are the FASB's free electronic newsletter that gives you information about upcoming meetings, new standards and proposed standards, board decisions from recent meetings, and so forth. You can sign up for that for free at the FASB's website, FASB.org. There are a series of drop-down menus. The one you'd go to is News and Meetings, the one all the way on the right. And you'd go down to Stay Connected, and you'll see that there's a sign-up form for that. Hopefully, we can also drop this link into the chat for you as well. A related question is, may my students who might not have a .edu email address register for the FASB email newsletter as well? And the answer is yes. Don't need to have a .edu address in order to be able to get this newsletter. Okay, so with that, let's just see what our audience mix is here on this. So 32% of you, probably those especially who are not with educational institutions or other, but then otherwise it's fairly mixed. 28% tenured professors and teachers, 9% tenure track, 20% adjunct, 6% department heads, and 5% PhD students. All right, so let's move on from there to our agenda. There we go. Great. So during the next approximately 100 minutes, we'll update you on the activities of the FASB during the past year. Rosemary will begin by providing a brief overview of what's currently on the FASB's technical agenda, and then Rosemary, Christine, and I will talk about several projects that we recently finalized and for which we've either already issued an ASU accounting standards update or will be doing so by the end of the calendar year. I'll then provide a brief overview of what's on the FASB Chair's research agenda, and then Jill, Lauren, and John will discuss in some depth 3 of those research projects. And then finally, John will remind you about the various academic initiatives that the FASB has that we hope are of interest to yourselves, your colleagues, or your students. Before John talks a little bit about our post-implementation review process and how we incorporate academic research into that process. Along the way, if you have any questions, we really encourage you to enter them in the Q&A tab, and we'll do our best to answer them during the webinar. So I'm now going to turn it over to Rosemary, who's going to start us off with the FASB's technical agenda.
Great, thank you, Jeff. So let's begin with a quick overview of the FASB's current technical agenda. So this slide lists out all the projects on our current technical agenda. We'll cover a number of these projects in detail as we go through the session, so I won't really discuss them individually here. But just to give an overview, we have 11 projects on our current technical agenda. Starting from the left on this slide, we have 1 project that's in deliberations. This is our cash flows targeted improvements projects that focuses on financial institutions. And that project was added because investors have told us over time that the cash flow statement for financial institutions in particular hasn't been particularly decision useful. And we also have a broader research project related to the statement of cash flows on our research agenda. Both of those projects have been on hold for a time to consider the feedback received through our agenda consultation process. And I'll mention that a bit more in a minute. In the center, we have 1 project with an exposure draft forthcoming, and that's on the measurement of PIK dividends. And then on the right side, you'll see that we have 9 projects that are in the final stage of our project cycle, and a final update is in drafting. All of these should be issued by or about the end of the year. So as we wrap up our current active projects, we also have feedback on our 2025 ITC on agenda consultation, and that will inform what projects the FASB will work on next. The comment deadline on that ITC was June 30th, and the staff is in process of analyzing the feedback. And the next step will be for the staff to come back to the board for a series of agenda decisions. So the board expects to process the agenda consultation feedback that we received and make decisions about what to prioritize over the next several months into 2026. So moving to the next slide. So with that as a background, we'll take a deeper dive into the projects on the technical agenda. We'll cover 6 projects where the board has made final decisions, and one that's already been issued as a final update, which is share-based consideration payable to a customer. So I'll start by going over a number of our financial instruments related projects. And I'll start off with our project on derivative scope refinements. This project actually addresses 2 issues, and I'll briefly cover both. So the first issue relates to the application of the definition of a derivative in topic 815 to certain contracts. So a bit of background, topic 815's definition of a derivative is pretty broad. It's characteristic based. In other words, it has a set of characteristics for an instrument to be assessed against to determine if it's in the scope, rather than a list of instruments that would be included in the scope. And as a result of that broad scoping, it captures a number of arrangements where stakeholders tell us that derivative accounting may not be the best reflection of the economics of a contract or an arrangement, and the information that results by applying topic 815 may not be decision useful for investors. Some of the specific types of arrangements people identified for us when they raised that issue are ESG-linked financial instruments, R&D funding arrangements, and litigation funding arrangements, but there have been others that the staff has identified during our research. The common thread is that all of these arrangements involve a contingent payment based on the performance of one of the parties to the contract. So stakeholders questioned whether fair value measurement is particularly useful when a contract relates to the performance of a party to the contract, and also that fair value measurement for that type of contract is very complex. So to resolve that issue, the board decided to create a new derivative scope exception for contracts with underlyings based on the operations or activities of one of the parties to the contract. And so that is a principles-based scope exception, in that the board decided not to create a scope exception for individual types of contracts so that it would be more durable. So there are a couple of caveats here. To qualify for that scope exception, a contract has to be non-exchange traded, and it doesn't apply to certain types of underlyings like market indexes, which are indicative of more traditional derivatives. In addition, the board decided not to capture contracts covered by other models that the board did not want to override. So in some cases, you can have a contract that will have an underlying that does qualify for the scope exception and an underlying that does not. Current GAAP in topic 815 already has a model for dealing with that type of situation where an entity would perform a predominant characteristics assessment. And whichever underlying is predominant would drive the accounting for the overall instrument. And so the board decided not to make any changes for that type of situation. Moving to the next slide. The second issue within this project related to an overlap that was identified in GAAP between topic 606 on revenue and topic 815 on derivatives. So consider a situation where an entity receives share-based non-cash consideration such as warrants from a customer as consideration for a transfer of goods or services. In that situation, stakeholders question which guidance applies when those payments are contingent on the satisfaction of the performance obligations. Would it be topic 815 on derivatives, or alternatively topic 321 on equity securities? Or should those instruments remain unrecognized until the entity satisfies its performance obligation consistent with topic 606? So the board decided to create some amendments that would clarify that topic 606 would apply in this type of situation until the entity has an unconditional right, other than the passage of time, to receive or retain share-based non-cash consideration. And to assess whether that right is unconditional under topic 606, only the contract terms that relate to the entity's performance obligations within the scope of topic 606 should be evaluated. Therefore, as a result of that decision, topic 815 and topic 321 would not apply until an entity has that unconditional right. So transition and effective date provisions are listed on the right-hand side of the slide. I won't repeat them other than to say that those provisions are the same for both of these issues, and there is a transition election provided in terms of being prospective or modified retrospective transition. And if an entity chooses modified retrospective for issue 1, there are some transition elections that an entity can make. So moving on to the next slide on hedge accounting improvements. So there's a bit of history with this project. So back in 2017, the board issued a very major targeted improvements standard to Topic A15 on hedge accounting. As often happens with a major targeted improvements project, there were a number of issues that stakeholders asked us to clarify after the standard was issued. So in 2019, the board issued a proposed update, but it didn't quite hit the mark based on the feedback that were received. And then as part of our 2021 agenda consultation, we heard that there were a number of additional issues in this area that the board was being asked to resolve. And those really related to the global LIBOR cessation that occurred and the introduction in the US of a new benchmark rate called the Secured Overnight Financing Rate that has a different structure than LIBOR had. So Topic A15 on derivatives and hedging had quite a few of its hedge accounting provisions that were structured around the structure of LIBOR. So stakeholders raised that in order to keep that guidance relevant, the board should address some of those issues that were affected by global rate reform. So ultimately, the board decided to tackle 5 specific issues raised by stakeholders, and those are listed on the slide. They're each pretty nuanced and discrete issues, so I'm not going to explain each of them individually, other than to say that they have a common goal, and this was also the goal of our 2017-12 update that I mentioned earlier. And the goal was to align risk management activities of entities with hedge accounting and to avoid uneconomic outcomes as a result of applying hedge accounting. I'll also mention that these 5 issues sort of span the gamut so that there's a bit of something for everyone. Issue 1, 2, and 5 are interest rate risk hedging issues, with issue 1 being more of a bank-focused strategy, and issue 2 being more of a corporate strategy. Issue 3 is a commodity price risk issue, and issue 5 is a foreign currency hedging issue. So these really did cover sort of a wide span of hedging strategies. Moving to the next slide. So this slide lays out transition and effective date provisions for our hedge accounting improvements project. I'll just point out here that there are different effective dates for public business entities and all other entities, and the reason for that was really to give private companies an extra year due to the complexity of the guidance in this area. But of course, early adoption is permitted. So moving on. So the last project I'll cover relates to the application of our CECL model to purchased financial assets. So a bit of background, why did the board take up this project? This was really driven by feedback that we received from stakeholders that were investors. And investors said that applying 2 different models to purchase financial assets, the CECL model, which is a day 1 loss model, and the PCD model, which is a gross up model, increases complexity and reduces comparability, and investors really preferred a single model. In addition, the application of the more than insignificant credit deterioration threshold for applying the PCD model was being applied inconsistently, and some actually found it difficult to apply. And then, of course, the non-PCD double count. So this is where a credit loss expense would be recognized in the income statement in the period of acquisition, but that is also reflected in the purchase price for the loans. So we understood that analysts were trying to adjust for the credit discount there. So the board decided to address those issues by creating a single purchase financial assets model. So the board considered comment letter feedback at a public board meeting in February, and at a high level, stakeholders identified a significant number of issues that needed to be resolved under the exposure draft. And that was really because It was trying to apply a model that was created specifically for purchase credit deteriorated assets to all purchased financial assets. So at the April 30th board meeting, the board decided to change the objective of the final project and to really just focus on loans, which was really sort of the problem area that stakeholders had identified. So the revised objective is to expand the application of the gross-up approach in topic 326 to only purchased loan receivables, excluding credit cards, that have not suffered more than insignificant credit deterioration since origination. So in terms of the visual on this slide, based on those decisions, this outlines the overall approach for accounting for credit losses on purchased financial assets. So to step through that approach, starting from the left, first an entity would assess acquired financial assets for the change in credit quality since origination. Moving to the center of the slide, those that have had more than insignificant credit deterioration since origination would continue to be accounted for under the existing PCD gross-up model, which is being retained in GAAP under this approach. The bottom middle box shows that loan receivables excluding credit cards that are not. So seasoning is defined as item 1 in the green box. And the reason to have seasoning criteria is really to differentiate these loan receivables from originated loans. So moving to the right then of the slide, those loans that are seasoned would be accounted for under the gross-up approach with some minor adjustments to make it operable. And those that are not seasoned would be accounted for like originated assets under the CECL model. So for this project, transition is prospective. The guidance would be effective for calendar year entities on 1/1/27, and early adoption is permitted. If an entity chooses to early adopt and chooses to do so in an interim period, the entity can apply the amendments either as of the beginning of that interim period or the beginning of the annual reporting period that includes that interim period. I'll turn it back to you, Jeff.
Okay, thanks, Rosemary. So we have another polling question. And this question is, at which point or points, you can answer more than one here, during a project's timeline, are you likely to discuss the project with your students? A, during initial deliberations, B, when a proposed update is issued, C, during redeliberations, or D, once the final update is issued. Again, you can answer more than one here. While we're waiting for you to answer, I want to see if any of my colleagues had a question that they'd like to address.
Hi, Jeff. I have one. So one of the questions that we received is, how is it that we work with the IASB on various projects? And we work with the IASB at all levels. So the staff communicate to the extent that we're working on similar projects so that we can learn from the IASB's experience and they can learn from our experience. There's also communication at the board level and at the chair level. In fact, we, as a board, will soon be heading to London for our annual educational meeting with our fellow friends over there in London at the IASB, and we'll have a full day of discussions about topics that are of mutual interest. So that communication is always ongoing, and I think it works well, and that we learn from each other. Thank you for that question.
Thanks, Christine. Let's roll out our answers here. And while a majority of you discuss these with your students once a final update is issued, it's encouraging to see that you're also discussing them with students along the way as the projects are proceeding, many of you. Okay, so with that, let me turn it back to you, Christine. You're going to cover our next couple of finalized projects.
Great. Thanks, Jeff. I appreciate that. Well, next up is the software cost project. There are two models to account for software costs, which have basically remained unchanged since they were developed in the 1980s and 90s. Subtopic 35040 applies to internal use software, which means software that a company is developing or purchased for internal purposes, like a CRM system. And subtopic 98520 applies to external use software, meaning software that a company plans to market externally through direct sale or licensing. And in addition, just to make things a little more interesting, the internal use model applies to software that is marketed externally to customers as a cloud accessed product, because that software is not technically transferred to a customer. These two models have distinct guidance with different rules regarding what is expense versus capitalized, subsequent measurement, presentation, and disclosure. Conceptually, the model in subtopic 35040 is a PP&E type model with costs incurred during the building phase, generally capitalized. In contrast, the model in subtopic 98520 is more of an R&D type model where costs incurred prior to establishing technological feasibility are expensed, and costs incurred after that point, but before the software is available for general release, are capitalized. However, many companies that apply subtopic 98520 guidance expense as incurred most, if not all, their software development costs like they would if they were treating those as R&D expenses. Next slide. Now, during the 2021 agenda consultation, we heard concerns primarily from preparers and auditors that the guidance is outdated and costly to apply. Mostly, that was because how entities develop software has evolved from the waterfall method, which was undertaken in stages, to the agile method, which is more incremental and iterative in nature. This was not a priority project for many investors, but most did indicate that they would like more transparency around entities' software cost expenditures. We did a number of years of work on this project, and by March of 2024, we decided to narrow the focus of the project to modernizing some of the language in subtopic 35040. The project is now complete and a final standard is in drafting, and it will be issued in the coming months. Next slide. The proposed amendments are limited to targeted improvements to subtopic 35040. To make the guidance neutral to the type of development method, the amendments remove all references to project stages throughout subtopic 35040. And instead, entities will begin capitalizing software costs when it is probable that the project will be completed and that the software will be used to perform the function intended, which we refer to as the probable to complete threshold, and also that management has authorized and committed to fund the software project. Now, since this language exists in the current guidance, we do not expect that these amendments are going to significantly change practice. However, in assessing the probable to complete threshold, entities must consider if there is significant uncertainty associated with the development activities, including whether the software is novel or unique, or has unproven functions, features, or technological innovations, and whether the entity is continuing to substantially revise the software's performance requirements. We expect that guidance, which is new, will come into play primarily to allow entities that develop software for distribution to customers via the cloud, which are, as I said earlier, currently and will continue to have to apply subtopic 35040. This guidance should allow them to account for software development costs like they would if they were scoped into the external software model in subtopic 98520. The amendments also supersede subtopic 35050 on website development and incorporate that guidance into subtopic 35040. And finally, the amendments clarify the application of certain disclosure requirements, but make no changes to the presentation and disclosure requirements in existing GAAP. Next slide. The new guidance is effective for all entities for annual reporting periods beginning after December 15, 2027, so calendar year 2028, but early adoption is permitted. And the amendments may be applied on a prospective basis to new projects or on a modified basis to new and in-process projects or on a retrospective basis. Under the modified approach, projects that are in process as of the date of adoption, for which capitalization began before the adoption date, must be evaluated to determine whether the costs are eligible for capitalization under the new guidance, and if not, then the entity would de-recognize those costs that had been previously capitalized. Next slide, please. So now I'm going to move on to another project. The Environmental Programs Project is a project to provide recognition, measurement, presentation, and disclosure requirements for environmental credits and regulatory compliance obligations that may be settled with environmental credits. Again, in response to the 2021 agenda consultation, some stakeholders had expressed concern about a lack of gap in this area and diversity in the accounting for certain environmental transactions, such as renewable energy credits, emissions allowances, carbon offsets, and cap and trade programs. Entities obtain environmental credits for a variety of reasons, including for use in settling regulatory compliance obligations. Some acquire them for trading purposes and also for voluntary purposes, such as meeting self-imposed pollution reduction targets, such as net zero. The accounting for environmental credits often is based on an entity's intended use of the credit, but there is significant diversity in practice. So, for example, compliance participants that acquire or are granted credits from regulators as part of an emissions control program often measure recognized credits at historical cost with no amortization or impairment. Trading participants that buy and sell credits to generate income often measure credits using historical cost with impairment or using a lower of cost or market model. And finally, voluntary participants that acquire credits to claim reductions against their actual emissions, either for regulatory reporting purposes or perhaps to meet their internally established pollution reduction targets, account for credits by expensing them immediately upon acquisition, but some also will recognize those credits as assets measured at historical cost less impairment, and others at a historical cost with no impairment. Next slide. So an environmental credit that is acquired, granted by a regulatory agency, generated internally, or received in a non-reciprocal transfer is within the scope of new topic 818. If it is an enforceable right that is represented to control emissions or other pollution and is separately transferable in an exchange transaction. In addition, an environmental credit obligation is within the scope of this guidance, provided it is an obligation that is arising from existing or enacted statutes that are represented to control emissions or other pollution that may be settled with environmental credits. Obligations that are within the scope of 41030 asset retirement and environmental obligations, however, are not within the scope of the new guidance, even if those obligations can be settled using environmental credits. So as a result, asset retirement obligations will continue to be accounted for under subtopic 41030. Next slide, please. The types of items that will be affected by these amendments include carbon offsets, carbon credits, renewable energy credits, renewable identification numbers, cap and trade emissions programs, baseline and allowance programs, and CAFE credits. Also included in the scope are environmental credits received from partnerships or other equity structures that generate credits. The types of items not included in the scope include transferable or refundable clean energy tax credits, additional payments made for carbon neutral activities where no credit is transferred, investments in partnership or other equity structures that generate credits, or sustainability reporting more generally. Next slide. This diagram on this slide summarizes our decisions regarding asset recognition and measurement. If it is not probable that the environmental credit, will be used to satisfy an environmental credit obligation or be sold, then it must be expensed upon acquisition, and we refer to these credits as voluntary credits. If, on the other hand, the answer to that question is yes, the credit is then going to be recognized as an asset, but the measurement basis will depend on how the credit is used by the entity. If it is probable that the credit will be used to satisfy an environmental credit obligation liability, the credit is measured at historical cost without impairment, and we refer to these credits as compliance credits. But if it is not probable that the credit will be used to satisfy an environmental credit obligation liability, meaning that it is likely held for sale, well, then the credit is measured at historical cost, subject to impairment, although we did provide a fair value option, which will allow certain of those credits to be measured at fair value. And we refer to those credits as non-compliance credits. At the reporting period, entities must reassess the probable use of their compliance and non-compliance credits. If a credit that was probable of being used to satisfy a liability or of being sold is no longer probable of being used for either purpose, then the credit must be derecognized through earnings. If an entity reclassifies an environmental credit from compliance to non-compliance or vice versa, then they must test the credit for impairment before applying the corresponding measurement guidance for that type of credit. And finally, if a credit was expensed because it was deemed voluntary at any point, the entity will be prohibited from subsequently recognizing that credit as an asset. Next slide. The diagram on this slide summarizes our decisions regarding liability recognition and measurement. A liability must be recognized when emissions occurring on or before a balance sheet date indicate that an environmental credit obligation exists. Because compliant periods often do not align with an entity's year end, we also decided that when determining whether to recognize a liability, the balance sheet date should be treated as the end of the compliance period. The measurement of the liability depends on whether an entity has sufficient compliance credits on hand to settle its liability. The portion of the obligation that is funded by on-hand credits is measured at the carrying amount of the compliance credits at the balance sheet date. And the portion of the obligation that is unfunded is measured at the fair value of the credits that would be necessary to settle the unfunded portion of the liability, unless the entity intends to settle the liability with cash, in which case the unfunded portion would be measured at the cash settlement amount prescribed by the program, or the entity intends to settle the liability using credits that it has obtained or will obtain through an existing commitment to purchase a fixed quantity of credits at a fixed price, in which case the liability would be measured at the cost basis of those credits. Next slide. Environmental credit assets and obligations must be presented gross on the balance sheet as assets and liabilities, respectively. We did not provide any additional guidance regarding the classification of related cash flows because we decided that the guidance within Topic 230 is adequate. We also decided to prohibit entities from capitalizing the cost of voluntary credits, even as part of another asset in accordance with other GAAP, and non-refundable deposits for voluntary credits must also be expensed as incurred. Finally, credits acquired and environmental credit obligations assumed in a business combination should be recognized in accordance with Topic 805. The acquired credits will be measured in accordance with Topic 805 as well, but the assumed liabilities will be measured in accordance with new Topic 818. Next slide. So finally, entities must apply Topic 818 retrospectively, subject to certain requirements which we put in place to ease the transition. The amendments are effective for public business entities beginning after December 15, 2027, so calendar year 2028. For all other entities, the amendments are effective for annual reporting periods beginning after December 15, 2028, so they get an extra year to transition to this guidance. But for both types of entities, early adoption is permitted. And I think that brings us to our next polling question, Jeff.
Indeed, it does, Christine. So the polling question is, how do you keep up to date with activities of the FASB? And here, as with the last one, select all that apply. A, I'm subscribed to Action Alert. B, I follow the FASB on social media. C, I watch the public board meetings. D, I keep up to date with a different method. Or E, I attend this webinar every year. All right, with that, I wanted to see if any of my colleagues had a question they wanted to answer.
Yeah, Jeff, I have a question related to the conceptual framework. I guess before I get to it, for those of you who have participated in our webcast in the past, you'll probably remember that we always had a section covering the conceptual framework and the work the board was doing in that area. I'm happy to report that the board has completed its framework now, so that's why you don't see it in this webcast. But the question that I received is, how does the board use the conceptual framework in standard setting? And that's a great question. The conceptual framework is a non-authoritative body of literature that the FASB uses in standard setting. And by non-authoritative, I mean that it is not GAAP. So it doesn't prescribe or tell you how to account for things, but it's a tool that the board uses when it deliberates accounting issues. For example, the conceptual framework has recognition criteria. So when the board is discussing whether an item should be recognized in the financial statements, the board will frequently refer to the recognition criteria in the conceptual framework when trying to make a decision on an issue.
Thanks, Jill. Let's roll out our answers here. And glad a lot of you are already subscribed to Action Alert. Again, help spread the word for that. And it looks like a lot of you attend this webinar every year, and you keep up through other means as well. Okay, so now I'm going to cover the last couple of finalized projects, one of which is already out there as an ASU. The first of them, not yet out as an ASU, is Accounting for Government Grants. And the Accounting for Government Grants projects has sought to establish guidance on the accounting for government grants received by business entities. It's a follow-on to the disclosure guidance that you may recall the board issued back in 2021. The board completed redeliberations on the proposed update back in June, and the staff is now drafting a final ASU. Just a little background. Because there's no existing GAAP for government grants received by business entities, there's, of course, some diversity in practice. Many business entities, especially public companies, analogize to the IAS 20 grant model in IFRS, while others analogize to subtopic 958-605, which is the U.S. GAAP model that applies to grants received by a business entity from a non-governmental entity, and to all grants received by not-for-profit entities. Let's move on to the next slide. We have a fair amount on this slide, but let me just sort of cut through it a little bit. The guidance in the forthcoming ASU will largely reflect the government grant model in IAS 20, but with a few targeted improvements. The scope of the guidance includes transfers of cash to fund future expenditures or to reimburse expenditures already incurred, and there's a wide variety of expenditures that could be there. Capital expenditures, wages, training, et cetera, R&D. The scope also applies to a transfer of a tangible non-monetary asset, such as a capital asset, for example, building, land, or equipment. It also applies to a forgivable loan when the recognition criteria are met, for example, the types of things we had during the pandemic, such as the Paycheck Protection Program loans. And finally, to a refundable tax credit that is not within the scope of Topic 740 on income taxes. For any of these, a grant should not be recognized until it's probable that A, the entity will comply with the conditions attached to the grant, and B, the grant will be received. The guidance distinguishes between two types of government grant, like IAS 20 does. First, a grant related to an asset, that is a grant or part of a grant that is conditioned on the purchase, construction, or acquisition of a capitalized asset. And the other type of grant is a grant related to income, which is any other type of grant. The guidance allows for two possible approaches in the accounting for a grant related to an asset. Under the first of those approaches, the cost accumulation approach, you'd recognize the grant in determining the carrying amount of the asset, and then there's no separate subsequent recognition of grant proceeds and earnings. Now, if you end up receiving a grant of a tangible non-monetary asset under this model, you'd initially measure it at cost, if any, to the business entity. And then with regard to presentation guidance, you'd present the grant on the balance sheet as an adjustment to the carrying amount of the related asset. And the cost basis of the asset adjusted for the grant proceeds would then be used to determine depreciation or other subsequent accounting for the asset. Now, in contrast to the cost accumulation approach, the other approach, the deferred income approach, would involve the recognition of the grant in earnings on a systematic and rational basis over the periods in which the entity recognizes as expenses the related costs for which the grant is intended to compensate, most notably depreciation expense. For a grant of a tangible non-monetary asset under this approach, you'd initially measure it at fair value when the grant is recognized on the balance sheet. Then with regard to presentation, you'd present the grant in earnings either separately under a general heading such as other income or as a deduction from reporting the related expense. Now, for grants that are not grants of assets, grants related to income, you'd have an approach that's similar to the deferred income approach, this latter approach, where you'd recognize the grants in earnings on a systematic and rational basis over the related costs that are intended to be compensated. And you present these in earnings either separately under a general heading, such as other income, or as a deduction from reporting the related expense. The final ASU is expected to be issued in the fourth quarter, and entities will have their choice of three transition methods: modified prospective, modified retrospective, or retrospective, and there's additional details on each of those on this slide. Now, for public business entities, the amendments will be effective for annual reporting periods beginning after December 15, 2028, and interim reporting periods within those annual reporting periods. For private companies, it will be effective 1 year later. Early adoption is permitted for both interim and annual financial statements, but if you do it for an interim financial statement, it must be the first interim statement, within an annual reporting period. Okay. Let's move on to the next slide. This is the other project. This one has actually already been issued. It was issued back in May as ASU 2025-04, and it was undertaken by the board to clarify the guidance on share-based consideration payable to a customer to address some inconsistencies in practice. Just a little background. Some entities offer consideration to their customers or to their customers' customers to incentivize purchases. Now, many cases that consideration takes the form of cash or a credit, but it could also take the form of share-based consideration that vests when specified volume or monetary amounts of goods or services are purchased. Now, under Topic 606, that type of consideration payable to a customer that's not given in exchange for a distinct good or service is recognized as a reduction in revenue. And since ASU 2019-08, Topic 718 has been used to measure and classify share-based consideration payable to a customer. Now, if the share-based consideration has vesting conditions, the grantor must determine whether those conditions are service conditions or performance conditions. And if it's a service condition, the grantor can elect to either estimate forfeitures up front or to account for forfeitures as they occur. And if it's a performance condition, the grantor estimates that the probable outcome and is required to reassess at each reporting date whether a performance condition is probable of being achieved. So you can see that this differential treatment here can impact the timing of revenue recognition. Move on to the next slide. The amendments here in 2504 will apply to all entities that issue share-based consideration to a customer within the scope of Topic 606. The amendments do a few things collectively. First, they revise the master glossary definition of a performance condition to include conditions based on the volume or monetary amount of purchases made by a customer or a customer's customers. Secondly, although with this first change, fewer awards are expected to be accounted for as service conditions, for awards that are determined to be to have service conditions, conditions. The amendments eliminate the election to account for forfeitures as they occur. You now need to be estimating them up front. And then finally, with that second change, a grantor, because of that second change, a grantor is now required to assess the probability that an award will vest using the guidance in Topic 718. The amendments clarified that a grantor should not apply the guidance in Topic 606 on constraining estimates of variable consideration to share-based consideration payable to a customer. Amendments may be applied on a modified retrospective or a full retrospective basis, and the guidance will be effective for years beginning after December 15, 2026, including interim periods therein. Early adoption is permitted. Let's move on to this last slide within this section. Now, we've just finished discussing some newly issued and pending ASUs, and this slide is just simply to remind you that over the past couple of years, the FASB has issued some ASUs on topics that many of you have indicated are of interest to you. The financial report and the financial reporting changes brought about by these ASUs are or soon will be reflected in the financial statements of public business entities. Quick reminder, those are on segment reporting, where we were particularly improving the reportable segment disclosures around segment expenses. Crypto assets, where we were requiring those assets within the scope of the amendments to be measured at fair value each reporting period, with changes in fair value recognized in net income. And we also added some disclosures around significant holdings, contractual sale restrictions, and changes during the reporting period. Our disaggregation of income statement expenses required disaggregated information about a public business entity's expenses to help investors understand performance, assess prospects of future cash flows, and compare performance over time and with other entities. And then finally, the income tax disclosures ASU, improvements ASU, addressed investor requests for more transparency in this area, especially around the rate reconciliation and income taxes paid information. And we encourage you to go to the links that are provided on this slide for more on these important ASUs. Now, moving on to the research agenda, Jill, Lauren, and John will be discussing a few of the FASB's current research projects shortly. But I first wanted to just give you a brief overview of the research agenda, its relationship to the technical agenda, and the projects currently on the research agenda. Next slide. As a reminder, it takes a majority of the board, a majority vote of the board, to add or remove projects from the technical agenda. But the items on the research agenda are chosen by the chair, currently Rich Jones. And generally, the chair uses the research agenda to gather additional information before asking the board about adding a project to the technical agenda. There are currently 9 projects, as you can see on the research agenda. We've indicated in green the 3 for which we've already issued invitations to comment. And the comment deadlines for each of those have passed. And as Jill, Lauren, and John will get into in a little detail, the staff is in the process of bringing summaries of the feedback we heard to the board for their consideration. The other 6 research projects involve hedge accounting, commodities, consolidation accounting for business entities, derivatives, and the statement of cash flows, as well as one that Rich just added a couple of weeks ago on digital assets. And as Rich explained when adding that project, that research project will explore some targeted improvements, particularly about whether certain payment digital assets or cash equivalents, and whether the accounting for and about the accounting for certain digital asset transfers, such as crypto lending. We'll be considering both feedback that we heard as a result of the 2025 agenda consultation, as well as recommendations released in the report issued by the President's Working Group on Digital Assets Markets. So stay tuned for more on that exciting research project. And with that, I'm going to turn it over to Jill, who's going to talk about our intangibles research project in a little detail.
Thanks, Jeff. I'm going to quickly start off with a project timeline. The board has been on quite a journey with its intangible assets project. This slide highlights some of the milestones of the project. The project began as a disclosure project, and in December 2020, the FASB chair extended the research project to include recognition. As a result of the 2021 agenda consultation, the chair clarified that the research project would also cover internally developed intangibles and R&D. In June 2022, the board decided to add a project on software costs to its technical agenda. The board has completed the deliberations in that project, and a final ASU will be issued shortly. In December of 2024, the FASB staff issued an invitation to comment, soliciting broad stakeholder feedback on whether the board should pursue a project on the recognition of intangibles. The comment letters in this document were due in May of 2025. So for the remainder of this section, I'm going to focus on the feedback that the board received in those comment letters. This slide just summarizes the questions that the staff was seeking feedback on in the ITC. And the questions were focused on whether there is a problem in US GAAP related to the accounting for and the disclosure of intangibles, what specifically the problem is, and the potential solutions that any stakeholders may have to solve the problem. This slide summarizes the feedback that we received on the ITC. Stakeholder views on intangibles continue to be diverse. The comment letter respondents provided mixed views on one, whether the board should undertake standard setting efforts in this area, and two, if so, what types of intangibles should be addressed and how the issues should be resolved. This slide summarizes at a very high level the comments that we received on the ITC. First, there is very little support for a broad reconsideration of all the accounting for all intangible assets, with the objective of creating one comprehensive principles-based standard that consistently addresses the recognition, measurement, presentation, and disclosure of intangibles. Related to research and development, the feedback on this topic was again mixed. However, some respondents provided suggestions on capitalization thresholds if the board chooses to undertake a project to reconsider the accounting for research and development. Some of the suggested improvements included considering whether all research and development costs should be capitalized or whether just development costs should be capitalized. Third, the board received quite a bit of feedback on aligning the recognition criteria for intangible assets acquired in a business combination, acquired in an asset acquisition, or internally developed. But again, that feedback was very diverse. However, those respondents expressed mixed views on what exactly the board should do. Some respondents thought the board should not undertake a project to align the recognition guidance for intangible assets. Others supported a project, but the views were mixed on whether the board should align the recognition guidance for all intangible assets, just acquired intangible assets, or just IPR&D. For those who supported a project, there were diverse views as to which criteria should be used to align the accounting. Several respondents suggested the board consider enhancing disclosures related to internally developed intangibles and R&D. Many of the suggested disclosures involve disaggregation of amounts on the financial statements. Several respondents provided suggestions for targeted improvements to the intangibles guidance. A majority of the targeted improvements related to business combination accounting and measurement. As far as the next steps, the board will discuss the feedback that it received at a public meeting that is tentatively scheduled for later this month. Okay, Jeff, I think we're up at a polling question.
Yes, we are indeed. So this question is, how did you learn about today's webinar? Just choose one answer here: social media, FASB email, AAA, or FARS email, word of mouth, or other. And while we're doing that, I just want to see if any of my colleagues have a question to answer.
Hey, Jeff. I have a couple questions to answer. So one of the questions that came in was, what is the trajectory of IFRS US GAAP convergence? So what I would say is that, as I mentioned earlier, we monitor each other's work very closely to the extent that we're working on similar projects. We learn from one another. We also, if the ISB is working on a project and we're not working on that project, or vice versa, if that is an area that we think we might work on in the future, we also monitor those projects so that we can learn from each other. And we are very focused on avoiding differences for differences' sake. That said, the IASB's mandate is to meet the needs of investors in the jurisdictions that apply IFRS standards. And the FASB's mandate is to meet the information needs of investors who participate in US capital markets. And because the costs and benefits can differ for investors that are operating within the US environment versus in other countries, there can be cases where the standards ultimately do differ in order to better meet the needs in a cost-effective way of those who are operating within the U.S. environment versus the international environment that the ISB is surveying. So that was one question. Do I have time for one more, Jeff? Or should we?
Maybe we should just hold it to the next, because I know we're a little bit behind here. We'll hold it to the next break.
I will do so. Thank you.
Thank you. So let's push out the answers. A lot of you heard about this through a FASB email, but you also heard about it through other means as well. So with that, let me turn it over to Lauren, who's going to talk about our agenda consultation.
Hi, thanks, Jeff. So as part of the agenda consultation research project, the board has sought input from a cross-section of over 200 stakeholders to begin this current agenda consultation. This included outreach with numerous stakeholder groups and FASB advisory committees, and the priority topics identified from those stakeholders formed the content that was eventually included within the agenda consultation. So as part of developing the agenda consultation or invitation to comment, stakeholders reflected that significant progress has been made on the priorities that were identified in the previous 2021 agenda consultation. And many stakeholders indicated that there is not really a case to make major changes to GAP at this time. And many of the topics that were suggested for standard setting efforts focused on targeted improvements to GAP, with either the objective to reduce complexity or enhance the information that is provided to investors. So in terms of the topics that were eventually selected, the topics were varied and they were organized under 8 distinct chapters. They range from combinations of entities and financial instruments and intangibles and retirement and other employee benefits, to the income statement and expenses and presentation and disclosure of financial reporting information, amongst other areas. The comment period ended in June 30th of 2025, and so far the board has received over 100 comment letters, and it's yet to consider that comment letter feedback and make changes to its technical and research agenda based on the feedback. And with that, I'll turn it to John.
All right, thanks, Lauren. So next, I'm going to talk about the research agenda project on financial key performance indicators, which I will refer to during this presentation to as KPIs. So the inception of this project was in December of 2021. Board members discussed feedback received on the 2021 agenda consultation, which included feedback on financial KPIs. In May of 2022, the FASB chair added a project to the research agenda. Then in May of 2024, the FASB chair announced that the staff would develop an invitation to comment document, or an ITC, to solicit stakeholder feedback on KPIs. In November of 2024, just this past year, the ITC was issued with a comment period deadline at the end of this past April. So the research objective of this project is to explore the pervasiveness of the perceived issues related to KPIs and whether technically feasible solutions exist. The scope of the research project is limited specifically to financial KPIs. So financial KPIs are any financial measure that is calculated or derived from the financial statements and or underlying accounting records that is not presented in the GAAP financial statements. And so financial KPIs can really be categorized into 3 different groups. First, you have measures derived from items presented in financial statements, which includes things like the current ratio. Second, you have financial KPIs that include measures derived by adjusting amounts that are presented in financial statements. An example would be adjusted EPS. And then third, you have financial KPIs that come from financial information or other underlying accounting records, such as EBITDA or free cash flow. So in terms of the perceived issues, there has been a stark increase in the use of financial KPIs. Specifically, the staff has seen an increase between 2013 and 2022. This increase can be seen among S&P 500 companies, but the increase is also even more prominently seen among SEC filers. And since standardized definitions of KPIs don't exist, this increased prevalence of KPIs potentially reduces comparability of financial statements. And so to look into this possibility, the staff reviewed a sample of public companies that report EBITDA and noted that the definitions of the components of EBITDA, so earnings, interest, depreciation, amortization, were typically not consistent. Furthermore, financial data services also calculate and provide financial KPIs, which provides this additional source of potentially uniquely defined KPIs that are out there. So on the next slide, in the November ITC, the staff provided two possible approaches that could potentially address the perceived issues with KPIs. And we were seeking stakeholder feedback on these two approaches. So the first approach is define certain financial KPIs within GAAP. Now, under this approach, there would be a few key decisions that would have to be made. So first, the decision would have to be over which financial KPIs to actually define. It could be broad, commonly used KPIs that are applicable to firms in multiple different industries, for example, such as EBITDA and free cash flow. Or alternatively, the definitions could be created for KPIs that are used in industry-specific situations, so in specific industries. In addition, another decision would have to be whether or not companies would be required to disclose these defined KPIs in their GAAP financial statements, or if the disclosure of defined KPIs would just be optional. So that's approach one. Under the second possible approach that was included in the ITC document, companies would bring financial KPIs that are presented outside of the GAAP financial statements into the GAAP financial statements. This approach is similar to the approach that's in IFRS 18 for management performance measures. And the key decision under this second approach is which KPIs would be subject to disclosure in the financial statements. It could be all management provided KPIs. It could be only those KPIs in earnings announcements and other regulatory filings, or it could be based on some other criteria. And so the comment period for this KPIs ITC closed as of the end of this past April. We received a total of 37 comment letters with feedback on these two approaches, with feedback on the relative priority of a project on KPIs, as well as feedback on other questions that we asked in the ITC. And the staff is currently in the process of summarizing this feedback, and it's going to be discussed at an upcoming board meeting. And I think now we're going back to Jeff with another polling question.
Indeed, we are, John. So polling question number 6, which of these current technical agenda projects or soon to be issued ASUs are you interested in conducting research on or teaching to your students? A, accounting for and disclosure of software costs, accounting for environmental credit programs, accounting for government grants, the purchased financial assets credit losses project, derivative scope refinements, or hedge accounting improvements. And with as you're answering, let me just see which of my colleagues have questions to answer. I think, Christine, I punted one of yours earlier, so I didn't know if you want to get back to that now.
Yes, I can do that. Thank you, Jeff. So the question was, if cloud software development, which is basically all software now, is treated differently, why would this not have a significant impact in practice? So it was our understanding through outreach that we did during the project that many entities were already getting to a point where they were fully expensing software costs, even under their application of subtopic 35040. The language that we added to the guidance is really just going to make it easier, I think, for those entities to get to that answer. That said, there may be some entities that were capitalizing more of the cost under the existing guidance. And for those entities, there may be less capitalization after the implementation of this guidance. But for the most part, for the vast majority of companies, we've heard that, and one of the questions actually that we asked during the exposure draft was feedback on whether this was going to create a significant change in practice. And for the vast majority of feedback that we received was that it would not. Thanks, Jeff.
Okay, terrific. Let's push out the answers here. So we have a plurality here of for accounting for and disclosure of software costs, and a nice mix of some of the other of interest in the other projects as well. With that, let me go back to John, who's going to talk about our academic initiatives.
All right. So we can go to the next slide here. Perfect. So the FASB has many academic initiatives with the goal of engaging with the academic community. I'll spend the next few minutes discussing 6 of the more prominent initiatives that are going on at the FASB. So the first initiative I'd like to talk about is my role, the Postdoctoral Fellow, or we abbreviate it as PDF. And every academic year, the FASB hires one new PhD accounting graduate to serve as the PDF. And the purpose of the PDF is to help integrate academic research into the standard setting process. So during the one-year appointment, the PDF serves on several of the active technical and research project teams, post-implementation reviews, and also acts as a general academic consultant to other teams. In addition, the postdoctoral fellow connects with the academic community. So this role has many benefits. The PDF gets firsthand experience with the standard setting process and gets to develop connections with preparers, auditors, regulators, users, board members. And so in my experience so far, just a couple of months on the job, I found that the connections and insights from these groups have been so helpful for coming up with interesting research questions and just really better understanding the standard setting process. So other benefits, PDFs also have access to in-house XBRL training, XBRL data. They also have access to the subject matter experts on standard setting that are on the FASB staff. And finally, the PDF has time to continue their existing research projects. The salary, benefits, and moving allowances for this role are competitive with other academic jobs. And so far, all 8 of the fellows in this role, including myself, have obtained faculty appointments and received a 1-year delay on their tenure clock. So the recruiting process for the next PDF will begin later this month, and we expect a submission deadline in November. So if you know of any candidate that would be interested, I encourage you to pass along this information to them. So in addition to the PDF, the postdoctoral fellow, the FASB offers a summer program for PhD students and faculty. During the program, participants get to observe a FASAC meeting, take a deep dive into the FASB's conceptual framework, engage in discussions with managers of specific projects, and socialize with FASAC members, board members, and also staff. We rotate this program annually between PhD students and faculty. So this past summer, it was faculty. So that means in 2026, we will be hosting PhD students. And then in 2027, we will again be hosting faculty. And we'll begin sending universities invitations to nominate participants this upcoming February. So keep an eye out for that if this is something that you might be interested in. Okay, next we have the Emerging Financial Reporting Issues Research Symposium. This is a 1-day symposium co-sponsored by the FASB and the Chicasian Accounting Research Center of the University of Chicago. And the Emerging Financial Reporting Issues Research Symposium encourages and supports research that is specifically relevant to standard setting. The format for the day includes 4 research paper presentations with papers discussed by an academic and also a standard setter. In addition, there's going to be 2 panels to gather views from a variety of different stakeholders. So the symposium is going to be held on April 3rd, 2026. And the topic of this symposium is going to be the benefits and costs of recently implemented standards. The call for papers, the submission portal, and other information is available on our website. And very importantly, the paper submission deadline is coming up somewhat soon. It's November 15th. So if you have a paper on the costs or benefits of any of our standards, I hope you'll give us the opportunity to consider your paper for the symposium by submitting it through the conference link. Registration to attend this symposium will be open in early 2026, and the registration fee is $175. There's room for about 50 registrants on a first come, first served basis. Now we can switch to the next one, Jack. Great. So next we have the FASB Emerging Scholar Award. This award recognizes a third or fourth year PhD student with a proposed doctoral thesis judged to be the highest quality in terms of its potential contribution to academic standard setting. In addition to being recognized, the winner of this award also receives $2,500 from the FASB and provides an initial opportunity for the winning student to discuss their research with the FASB staff. The nomination information is available on our webpage, and we'll be accepting applications starting in early February. And on that note, on the next slide, there we go. I'd like to recognize the most recent ESA recipient, Matt Peterson from the University of Kansas. Matt's dissertation examines the statement of cash flows and how the presentation and the display of certain cash flow information can make the cash flow statement more useful for investment decisions. So congratulations to Matt. Okay, so now we have the Postgraduate Technical Assistant Program, or for short, PTA program, which I'm personally a big fan of because I got to be a PTA before I was a postdoc fellow back in 2017. So I can attest that it's a fantastic program. So this is a one-year PTA program, and it targets students in a master's degree or in a double major. So for example, students that are completing their master's in accounting or students that are completing a double major in accounting and finance, for example, would be eligible. PTAs get to work on projects on the technical or research agenda, as well as short-term practice and implementation issues. They are involved in all phases of the standard setting process. They get to participate in public board meetings, task force meetings, and the skills and networks that PTAs develop through this program is truly unmatched. During their time, PTAs get to interact with business leaders from a variety of fields like audit, finance, and more, and they just get to receive this exposure to the standard setting process that is so unique and so impactful. This program is highly selective. Someone within the accounting department of the student school must nominate students to apply for the PTA position. And we will kick off that process later this month by emailing schools an information packet. If you think your school is not on the email list to receive this information and would like to be added, please send an email to humanresources@f-a-f.org. It's on the slide here. We have positions available for both winter and spring start dates, so that just depends on the student's graduation timeline. Okay, and last slide on this section is on academic resources, or I should say the landing page for our academic resources. So for anyone interested in participating in any of these initiatives I've talked about so far, please visit this academic page. Hopefully this page is something you're already familiar with, but if not, it's a very helpful spot for details and resources related to all of these initiatives, as well as some other initiatives I didn't discuss. And actually one worth briefly mentioning is the FASB's academic research portal. If you have any research that you believe is relevant to the FASB or one of its projects, please submit that research via our portal. We welcome all submissions, whether it's a published paper or a working paper. And if you have any questions on any of this, you can always contact me at the academic email address, academics@fasb.org. Okay, and I'll pass it back to Jeff.
Thanks, John. Another polling question for all of you. Which FASB academic initiative that John just described are you most interested in? And actually, you can select all that apply here. So the postdoc fellow program, the academic landing page, the PTA program, the PhD or faculty summer programs, the Emerging Scholar Award, or other. And as you're answering that, let me turn it over to whichever one of my colleagues wants to answer a question.
Thanks, Jeff. We received a question here that states, is there or do you expect there to be a FASB equivalent to IFRS 18? In terms of what IFRS 18 is, that is the ISB's equivalent called Presentation and Disclosure in Financial Statements. It is a relatively new standard that requires 2 new defined subtotals under IFRS, operating profit. It also requires a measurement performance measure, and it also includes principles for aggregating and disaggregating certain information. At this point, the board does not have a technical agenda project on its project list to address an equivalent project in that way. Having said that, there are certain aspects of the work we are doing on our research agenda that are somewhat similar and somewhat aligned. For example, John talked earlier about the KPI project, which does have some similarities to IFRS 18's management performance measures. The board obviously could go in a very different direction, but there are some aspects of that that the board might look at as it goes through its technical agenda.
Anyone else? Yeah, go ahead, Christine.
I was just going to say, and I think I'll also add to that, we do have the disaggregation of income statement expense project that was issued in 2024 that provides guidance for U.S. companies on how to disaggregate certain line items on their income statement, like cost of goods sold, SG&A. And so that project also has some overlap with IFRS 18. One other thing I wanted to do before I let Jeff go through the responses to the polling question is I just wanted to add my encouragement to John's regarding the Emerging Financial Reporting Issues Research Symposium that will be held in April of 2026 on the costs and benefits of recently implemented standards. If you have research that is on any of our standards that would help us to understand benefits and costs better, please do share that research with us. And I would also like you to invite you to attend the symposium in April. It will be the last symposium that I will be attending as a board member, and it would just be wonderful to see so many of you there. So please consider that as well. The conferences have been very well received, and they're a lot of fun. And with that, I will let you get back to the polling question, Jeff.
Thanks, Christine. So here are your responses, and we're very grateful that you have a lot of interest in a number of these areas. I see that there are a fair number of folks who checked other, and if you wanted to drop into the Q&A or whatever, your thoughts on what other would be, we'd certainly be glad to hear those. Okay, with that, let me turn it back to John, who's going to talk about our post-implementation review process and the role of academic research in that.
Great. Thanks, Jeff. All right, so Jack, you can go ahead and go to the next slide. So the post-implementation review process is an evaluation of whether a standard is achieving its objective by providing financial statement users with relevant information that justifies the cost of providing the information. So after the issuance of certain standards, the PIR process begins, and this is a multi-year process. The PIR is conducted under the oversight of the FAF trustees, specifically the Standard Setting Process Oversight Committee, and the commencement of the PIR is announced publicly. In addition, the staff will also announce opportunities for stakeholders to participate in providing feedback, and then updates on the PIR process are made to the board in public meetings. And also at the end of the PIR process, a final PIR report is made publicly available. So in performing the PIR, there are 3 key objectives. So first, the objective is, or objective 1 is to determine whether the selected standard is accomplishing its stated purpose. And within this objective, the PIR process attempts to evaluate if an issued standard resolved underlying issues, provided decision useful information, whether the standard is operational, whether it resulted in any significant unexpected changes to financial reporting or operational practices, or to determine if there were any unanticipated economic consequences. The second objective of the PIR is to evaluate the standard's implementation and the continuing compliance costs and related benefits. And specifically, the goal under this objective is to evaluate if both the costs and benefits that are realized are in line with what the board expected those costs and benefits to be as they were deliberating the standard. Finally, a third and somewhat more broad objective is to provide feedback on the standard setting process to determine if any improvements are needed. And in essence, the function of the PIR is to act as a quality control mechanism to ensure that the standard setting process is operating at its full potential. I also want to explain how PIR oversight works. So the FAF trustees are the ones that oversee both the board and the PIR team's activities. PIR activities are initially initiated by the FAF, and then the PIR is conducted by the PIR team, which is on the FASB staff. There is regular communication between the board and PIR teams throughout the PIR process. However, the PIR team is accountable to the trustees, not the board, even though the board is involved throughout the process. Okay. So this slide provides some more granular details about the PIR. And within the PIR process, there are 3 stages. And notably, the stages here are overlapping. So the PIR team may be performing multiple activities from different stages at the same time. Stage 1 is the post-issuance state implementation and monitoring stage. This stage generally lasts 3 or more years, during which the PIR team monitors implementation efforts in consideration of whether there might be a need for any possible improvements, a deferral of the effective date, any practical expedients. And in addition, during this stage, the PIR team assists stakeholders with application questions. Stage 2 is the post-effective date evaluation of costs and benefits. This stage generally lasts 3 to 5 years, during which the PIR team compares realized costs and benefits with expected costs and benefits, so kind of in line with that second objective of the PIR. And this is the stage when companies start to issue financial statements that reflect the adoption of the new standard. So at this point, the PIR team monitors the initial reporting of companies in order to identify, again, are there any possible improvements? Is there any confusion with application of the standard? And then the third standard, or the third stage, is the summary of research and reporting. And this stage is the shortest of the 3 and generally takes 1 year or less to complete. During this stage, the staff compiles the findings from the first 2 stages of the PIR and reports those findings to the board in public meetings. And finally, the findings are compiled in the stage 3 into a final report that is published publicly. Okay, so next I'm going to talk about how academic research plays an important role in the PIR process. So in these 3 different stages we just talked about, the academic community plays a really important role in all 3 of these stages. So in stage 1, the implementation and monitoring stage, the FASB staff communicates with academics in order to stimulate research topics that align with what the staff believe are important and relevant to achieving PIR objectives. This initial contact with academics will include webinars, roundtables, calls for papers that discuss researchable questions that are of interest to the FASB. And then in stage 2, the evaluation of costs and benefits, this is where the bulk of academic involvement comes into play. We engage in multiple activities during this stage in order to identify and consume relevant academic research. These activities will include conferences, outreach calls, sponsoring academic research or efforts, and then the staff will review and synthesize relevant academic literature. And this process is similar to a literature review, except the focus is on identifying what are the contributions that are especially meaningful from a standard setting perspective. And this process involves steps that You might be familiar with a regular academic review, searching SSRN, Google Scholar, but we also have access to submissions that are sent to us from the FASB academic portal, submissions to FASB conferences, and then we also monitor other academic conferences for useful research. And then the academic fellow or the PDF, so my role is typically leading this process and will review papers for quality. And then we get stage 3, and this is where the findings from these studies get integrated into that final report that's sent to the trustees. Okay, and then I want to call out specifically the webinars, which I was referring to before in stage 1. This is one of the ways in which the PIR team communicates with academics through these online webinars. And these webinars are a great resource for academics. During these webinars, the PIR team will provide a general overview of the standard that's undergoing the PIR process with information such as perceived issues that are related to the standard, the considerations that led to the specific ASU being issued as a solution, and then questions of interest that could be addressed through academic research. We also keep these webinars posted on the website for a fairly prolonged period of time. So even if you missed these webcast, archived recordings remain available on the website, and you can actually reach them by clicking on the links that are included on this slide. And then just as a note here, so there are 3 standards listed on this slide. These are the 3 most recent PIRs that have been undertaken. The PIR for the first topic, ASC 606, revenue from contracts with customers, has been completed. On the next 2 slides, I'm going to provide an update on the other 2 ongoing PIR projects, topic 842, topic 326. And then I'll talk a little bit about, a little more about academic research and its role in these projects. So topic 842, leases. Currently, the staff is still in the process of conducting this PIR. However, as you can see on the slide, it's highlighted that the team is currently in the final stage of the leases PIR, the research and reporting stage. And the staff recently provided an update on the PIR process just this past Wednesday at a public board meeting. And actually, if you're interested in watching this meeting, you can find it online on the FASB YouTube page. In addition, the staff is currently in the process of preparing a final report for the Standard Setting Process Oversight Committee on ASC 842. Okay, next slide. The second PIR that is still in progress is the PIR for ASU 2016-13, which is the current expected credit loss model, referred to often as CECL. And relative to the leases PIR, the CECL PIR is at an earlier stage. And the team is currently in the process actually of collecting and synthesizing academic research to be used in our evaluation of the benefits and costs of CECL. And so on that note, if you're currently working on any research that relates to CECL, now is really the perfect time to submit that research to us. I talked about this during the academic initiatives, but as a reminder, you can submit your research to the FASB through the academic portal or through email to academics@fasb.org. You can also submit it to the EFRIRS because it's very much in the scope of that conference. And so basically sending your research to us guarantees that we don't miss it, that we are able to look at it and are able to benefit from the insights of your work. Okay, so finally, I just wanted to give a little context on the PIR academic review by listing some of the key takeaways from the leases literature review, which was discussed at the PIR update board meeting just this past Wednesday. So some of the findings that were of special or was especially interesting to the board and to the staff included these 3 on the slide. So first, that reporting or reported operating lease liabilities and assets under the new leases standard reflect lessees' obligations and rights more precisely than the amounts disclosed under legacy GAAP. And in certain instances, studies showed that the increase in precision is actually somewhat large. Second, several studies examined how companies with capitalized leases experience changes in their cost of capital, whether in the equity market or the debt market. And overall studies show that there was a significant effect in response to reporting these lease liabilities and right-of-use assets on the balance sheet. And finally, this third point, while there were some concerns by stakeholders that the new leases standard could cause economic harm on companies that rely on leases, The empirical evidence does not provide results that are consistent with that concern. There did not appear to be a negative economic or there weren't empirically, there wasn't much evidence of negative economic consequences. And okay, that is everything I have on the PIR process. So I'll pass it back to Jeff.
All right. Well, thank you, John. So for polling question number 8, we're actually asking you for some input that will help us in planning future editions of this webinar. Here we would like to get the audience's input on the date of this academic webinar, which has historically been scheduled on the Friday after Labor Day, such as today. A, continue to hold it on the Friday after Labor Day. B, move it earlier, for example, Friday in August. C, move it later, for example, Friday later in September or in October. Or D, I don't have an opinion. Love to hear your thoughts on that. Before I turn this over to my colleagues to answer questions, I just want to give you an idea of our game plan. We will be staying on through 2:45, and the reason we do stay on the extra 5 minutes is just to make sure that we hit the 100-minute mark for all of you, so you can get your maximum CPE credit if you've been on the whole time. So again, we will be answering some questions now. I will then give a brief and maybe shameless plug to our upcoming webinar on government and nonprofit accounting, FASB GASB webinar, and then we'll finish answering some questions, and then again we'll break at 2:45. So let me see if any of my colleagues, as you're answering this question, let me see if any of my colleagues have questions to answer.
Hi, Jeff. I have a couple questions related to intangible assets.
Great.
I'm going to bundle them all together. So one of the questions is, what is the research project on intangibles expected to achieve? And as I had mentioned earlier, this project is on the research agenda. So what that means is the board is not actively deliberating this project. So what is going to happen is the board is going to discuss the feedback received, and then it's going to evaluate that feedback against the board's agenda decision criteria and decide whether it is going to put a project on its agenda to resolve an accounting issue. And at that time, an objective of the project will be established. So at this point, it's not an actually technically active project, and there is no specific objective. The other question that I got was related to intangible assets themselves and whether we believe an intangible asset varies significantly by industry. What I can say about that is based on the feedback that we received from the ITC, we've definitely heard that intangibles are varied in nature and depending on a specific entity in a specific industry. So my answer to that question would be yes.
Other questions anyone wants to answer? All right, well, let's, in the meantime, push out these answers. Looks like a significant plurality of you would prefer that we continue to hold this the Friday after Labor Day, though some of you would prefer we move it earlier, some later, and some of you do not have an opinion on this. So let's move on to the next slide, and then we'll continue answering questions. And again, we're going to stay on until 2:45. All right, so I said shameless plug again because I am part of this webinar as I've been each year. Each year, in addition to the general academic webinar that we're just about to complete, we host with the GASB a webinar aimed at those who teach and do research in the governmental and not-for-profit area. Now, if that describes you, your colleagues, or your students, we hope you'll join us and help spread the word. This year, the webinar will be held on Friday, November 14th, and we'll be opening the registration for it by early October. And the webinar will feature myself and my colleague on our not-for-profit team here at the FASB, Jeff Cabello, as well as the GASB's senior research manager, Tammy Waymeyer, who came to the GASB a couple of years ago after being a tenured professor at Middle Tennessee State University. All right, let's move on to the last polling question, and we'll answer some more questions as you're answering this one. Okay, this one actually has to do with the shameless plug. Do you plan on attending the governmental and not-for-profit accounting webcast for academics in November 2025? At least your initial answer here. Yes, no, or maybe. And as you're answering that question, let me see if any of my colleagues have other questions to answer.
Hey, Jeff, I do have a couple questions on digital assets that I will try to answer. So one question was, why is digital assets a separate research project? And another question is, which issues are being considered in the research agenda project on digital assets? So as you may know, our chairman, Rich Jones, added a research project on digital assets, certain issues to be looked into in an August board meeting. And it's a little bit of a unique area because the feedback that we've been getting in that area has come from multiple different sources. First of all, it's turned out to be an area where we've got a significant amount of feedback coming in through our agenda consultation process. But then also, you may be aware that the Genius Act was passed, and there is some intersection with some provisions in the Genius Act with the accounting for payment stablecoins. And in addition, there's a President's Working Group report that's been issued that had certain recommendations for FASB in terms of some accounting issues related to various types of digital asset issues. And so the research project is looking into broadly a number of different issues. We are looking at the determination of whether a stablecoin can be a cash equivalent under GAAP, and also crypto lending transactions, with which there are a number of flavors of those transactions, and trying to determine where does that fit in terms of our derecognition models, or does that type of transaction need a new derecognition model? And so those are just a couple of the areas that we are in early stages of research on with respect to digital assets.
Rosemarie. I have a couple questions that I was going to respond to. So first of all, we received a question about the timing of the final ASUs and whether they will be issued before September 30th, 2025. I can't give you a firm date on those. The drafting and the publication process takes time. There's several projects that are going through that process right now. And as a result, the best I can tell you is that the projects will be coming out kind of throughout the remaining part of this year. And we do expect that all of them will be issued before the end of the year, but I can't say firmly the timing of any of those. And in terms of proposed accounting standards updates, I think, Rosemarie, you can correct me if I'm wrong on this, but I think the only one that is on our technical agenda currently is the PIK dividends, and that one also we don't have a firm date, although we anticipate it should be coming out in short order, but I can't be any more specific. Is that fair?
I think that's absolutely fair. Yes.
Okay. That sounds good. The other question that I had was what determines whether a project is subject to a post-implementation review? And it's really the magnitude of the project and the magnitude of the change that it created. So, the three projects that we've been doing post-implementation review on were massive projects: the revenue, the leasing, and the CECL implementation project. And so it's really limited to those large projects. But that said, we do not formal post-implementation review, but we do implementation review pretty much for all of our standards in an informal process through interactions with various advisory groups, where we will ask them about how implementation is going, whether the standard achieved the benefits that were expected, whether the costs are in line with what they anticipated. And that is just a normal part of our process that happens with all of those smaller projects and standards as well. Jeff.
Thanks, Christine. Do we have responses? Okay, so it looks like a fair number of you are planning to join Jeff and Tammy and me on November 14th. We look forward to being with you then. And for those of you who aren't yet sure, otherwise may not, or if you would also help spread the word and to your colleagues and your students, anyone who's interested, we'd love to obviously have as many folks as possible on that webinar. Okay, with that, let me turn it back to Christine, who's going to close us out.
Wonderful. Well, I just want to thank you all for sticking with us today. I hope you found this webinar to be useful and informative. Of course, if you ever have any recommendations for us on how we can improve and better meet your needs and support you in your research activities and in your teaching activities, please do share those with us, because we are very open to suggestions. And since this will be my last webinar as a board member, I just want to extend my personal thank you to all of you for the last 10 years of support that I've received from the academic community and that our activities have received. It's been a great pleasure to work as the board member with the academic bent, and I just want to say thank you. So enjoy the rest of your day.